Market volatility and denominator bias. A favorite line. You hear me say it from time to time here when making comparisons. Which weighs more, a pound of lead or a pound of feathers? They're the same thing. Well, when it comes to the stock market and how the media basically covers the stock market, and especially volatile moves, and we've seen a lot of them over the past couple of months, they focus on the points. How many points? Oh my God, the markets were up 700 points. Oh my God, the markets were down 1,000 points. Well, this is what we call denominator bias. Now, I remember pretty vividly the market swings that took place during the Great Recession. I remember when the first was a TARP deal was rejected and the sell-off after that. Well, let's say the 1,000 points in 2008 is not the same as 1,000 points today. However, like I said, the media doesn't care about that. Basically, there's this thing, and we like to call it, it was actually coined by Kip Viscusi and Richard Zeckhauser. It's called denominator blindness. It's the tendency to focus on what? The top of the fraction, not the bottom of the fraction, or the magnitude of bad outcomes, not on the total number of events from which those outcomes are drawn. So again, it's the percentages, people. And you're taking a look at market moves, and we've seen obviously some very, very large market moves, but the point numbers are what actually gets the people going and makes it a hell of a lot more drastic. If you were to ask any investor if the stock market is more volatile than it used to be, more often than not, you're going to say, absolutely. Oh my God, the Dow moves 100 points all the time in a day. It's no big deal. And again, I'm dating myself. Okay. 100-point move when I started in this business, that was a massive move. It's interesting. Even when we've seen the spike in volatility, the market has fluctuated far less sharply in the last 3 years than has been typical in the past. 100 points right now is 0.6% change in the Dow. 1,000 points, okay, that's a 6.6% decline. But how significant is that? Again, listen, markets basically take a look at their cyclical adjusted price earnings ratio, CAPE, which Robert Shiller came up with. Yeah, stocks are higher than their historic average. That there's no doubt about that. But the reality is times are different. Things change. That is a great piece. And he's actually a pretty great writer for the Wall Street Journal. I got to give credit where credit's due. He's been doing a pretty good job. Jason Zweig did a bit on the psychology of this and the 1,000-point drop. And he said historical data might feel as unchanging as an exhibit in a museum, but the financial past is non-stationary. As St. Augustine pointed out more than 1,600 years ago, time is a continuum. Today's returns will be in the market's past results tomorrow, and the long-term return changes slightly almost every day as the latest increment or decrement of performance gets averaged into it. And again, this is one of the things that we try to get people to focus on. Again, not the noise, not the scare tactics, not the major swings, which are not as major as they used to be, but where it's going to be down the road. Beware of, don't be blinded by denominators, right? Or is that right? Be blinded. Yeah, don't be blinded by denominators. Watch TalkingWallStreet.com.